So let's not kid ourselves. The market hasn't been kind in 2022. Nasdaq is down 32% year to date. If we were to take a look at the fangs of yesteryear, Apple is down 21% year to date. Amazon is down 32%. Alphabet down 33%. Netflix down 59%. And Microsoft is down 29%. Yes, I'm still obsessed with the fangs of yesteryears. What's the point of changing the different acronyms to MAMA or even MANA, where every single stock is falling every other day? Anyway, Meta has performed the worst in the lot, with a negative 60% year-to-date performance. So we always hear people advising you to look at the long term, right? Zoom out, my friend. So Facebook, on a 5-year basis, has returned shareholders a whopping negative 20%. That's a CAGR of negative 4%. Sounds fantastic, right? Okay, enough with the sarcasm, but we can never get enough of the like button. So please remember to tap the living out of it. Also, this video is sponsored by Weibo. So I know many of you smart investors out there have already taken advantage of the different sign-up rewards in the past 3 months. But in case you haven't, Weibo recently leveled up their game again. And from now until the 30th of September 2022, every new sign-ups will get up to $130 USD worth of Tesla shares. So I'll leave the link and instructions down below. Essentially, you just need to deposit at least 2,000 Singapore dollars and execute one buy trade of a stock or ETF and one option, and you'll get an 8% ROI from the sign-up rewards. Definitely a lot better than Alibaba. So I'm currently using Weibo for my 15,000 portfolio as well. So don't let this guaranteed deal get away. Link in the description box. Anyhow, so what's the issue with Meta platforms today? Was there a new guidance on how top-line revenues or even bottom-line profits are going to be impacted? Last I checked, I only remember Meta warning employees of the upcoming restructuring exercise in hopes of probably tightening cost controls. Then, is it because of how TikTok is going to destroy Facebook and Instagram again? So based on the most recent data from Sensor Tower for Q3 of 2022, Meta's family of apps still take 4 positions out of the top 5 overall download worldwide. But yes, TikTok remains first. How about the upcoming recession? Since every mother's son is talking about the upcoming crisis in every part of the world, advertising will definitely take a hit, right? Meta posted a $13.77 earnings per share in 2021. So for this fiscal year, the consensus amongst 41 analysts is that Meta's EPS estimates around $9.78. So that's around a 29% haircut in bottom line. So I guess that's not enough. Not too sure what the market is expecting though. Maybe a 50% drop in profits for Meta platforms? Since the market tend to be forward-looking, many of these so-called quote-unquote expectations are kind of priced into the stock already. So what exactly is going on? Firstly, as the saying goes, a rising tide lifts all boats. Similarly, a tsunami is going to sink most, if not all of the ships. So when we are in a bear market, negative sentiments easily cause huge downward pressures on valuations of companies. So to add cherry on top of the cake, companies with quote-unquote weaker fundamentals are going to be punished even more excessively. So this is why you see all your so-called growth companies getting destroyed disproportionately, especially if they're not even making a profit. That said, Alibaba was also smacked off the face of the earth. But that's because of another factor, of course. Similarly, out of the whole basket of FANG stocks, Netflix and Meta is currently in their reinvestment phase. Hence, investors are heavily discounting their valuations due to the big uncertainty looming over the execution of these two said companies. Also, since most of the chatter online is around how deep the next upcoming recession is going to be, everyone is attempting to guess how bad the next few earnings quarter is going to turn out. And Meta, being a cyclical stock, is definitely not helping. Essentially, when the economy is booming, every Tom, Dick and Harry company wishes to advertise and grab consumers' eyeballs. Marketing budgets of big corporates are through the roof as well. On the flip side, however, when everyone is worried whether they can even survive for the next quarter and to want to turn profitable as soon as possible, marketing budgets would be the least of their concern. And advertisers like Google and Meta models after the ebbs and flows of the economy. Oh yes, and since the Fed is going to continue raising the Fed funds rate to combat inflation, it also just means that, hey, the risk-free rate used for discounting all the different asset classes are going to the moon. And that's exactly what we don't want. In layman terms, previously, when the risk-free rate was less than 1%, investors will be looking down on those instruments, thinking that they can get better returns elsewhere, like the stock market. Now, as the risk-free rate continues to climb, the decision to park your money elsewhere becomes a much tougher call compared to those said bonds. So assuming that the implied stock market return is 6%, initially when risk-free was near 0%, you are willing to risk your capital in the stock market for that so-called 6% spread or that implied equity risk premium. Now, if the implied return still stays at 6%, why would you risk putting your capital in the market when you can get an alternative that is the risk-free at 4%, even though it might be slightly lower? But hey, it's risk-free. Hence, in order to incentivize investors to deploy their capital in the markets again, the market has to drive the spread up back to 6%, so causing the implied market return to 10% in this hypothetical case. And of course, higher prices gives you lower returns. And in order to drive up the implied return, prices have to go down. And that's basically Finance 101. All the numbers used here are arbitrary, but I hope you get my point. And also, thank you for coming to my TED Talk. Now, I just wanted to draw your attention to this scenario analysis furnished by Professor Damodaran in his latest video. So he's essentially laying out the case for the different alternatives of the current S&P valuation. There are basically three variables that he used: the long-term risk-free rate, earnings expectations, and the implied equity risk premium. So for those of you who needs more explanation or guidance in terms of these three factors, I'll leave the link to his video in the description box down below. Personally, I think that since the main consensus on the street now is that we are probably going to enter into a mild recession, earnings will probably be 15% below estimates. And I'm guessing, of course this is my own conjecture, that the long-term risk-free rate will hover between 3 to 4% with an equity risk premium of around 5 to 6%. And with those assumptions, I think there is still some room for the S&P 500 to continue falling. But hey, who am I to judge? Lastly, to close up this discussion on meta platforms, I've seen many online commentaries saying that why would you buy Facebook, which is a lousy business by the way, they must always add that in, when Google, which is Alphabet, is trading at a PE of 19 or something. For one, Facebook is currently trading at a PE of 11. For two, if the recession is going to be as bad as how everyone claims it out to be, and the ad business is going to slow down significantly, I don't see why Google will be immune to all the different changes in the environment. But I do agree that Google have a much stronger moat compared to Facebook. So I'll gladly become an Alphabet shareholder, when the price is right of course. And for three, Google's EPS for 2021 was $5.61, and the current estimates for 2022 is $5.21. That's a 7% haircut. I don't know how much I should trust these projections moving into 2023. I've also come across a recent tweet related to Google, and I'll just leave it here for your own consumption. I'm not going to opine on it, but I guess it's just another perspective that you might want to consider. So when I look at your big techs today, Microsoft seems to be the darling that goes under the radar, and nobody pays much attention to them because it's kinda boring. What's your favorite big tech company? With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!